There's a megatrend taking Wall Street by storm. Do you know what it is? Stick around, we'll fill you in. Welcome everyone, show's called Your Money or Wealth. My name's Joe Anderson, president here at Pure Financial Advisors. And of course, this show wouldn't be a show without the big man. Well, wait a minute. Aloha, Mr. Allen.
Hi, Joe. I made this plumeria lei yesterday just for you.
You did, huh? You made it yourself.
I did, because I can't go out and buy anything. I'm in quarantine.
So we're talking about a new investment megatrend in regards to people's investment behavior. And it's not necessarily getting out of the overall markets or picking individual stocks. It's picking, social issues that they're passionate about. It's called ESG investing. Is it a fad, or is it going to take Wall Street to a different level? That's today's Financial Focus. Let's talk about sustainable investing, or ESG, or impact investing, social responsible investing. It's a new trend, if you will. Is it a mega trend? Well, it sure looks like it. In 2012, there's about $3.7 trillion in these types of investments. I fast forward to 2018, it's almost at $12 trillion. Even in Europe, the globe, it's taking the globe by storm. And then when you look, people are extremely interested. 70% of investors willing to pay more for their goods and services from companies where their values are in line. Let's break this thing down. Let's bring in the big man from Hawaii. Aloha, Mr. Clopine.
Oh, am I supposed to be doing something?
That's your cue, brother. Okay. You got your slide.
I didn't know you were doing that. Okay. Joe, we're going to talk about portfolios with a purpose, investing with your conscience. So first of all, what is the megatrend? What is this all about? Secondly, ways to invest, how to have an impact. And then there's a lot of misconceptions or myths. We're going to break down those myths so you sort of get the real scoop on what's going on. And then finally, megatrend shortfalls. This type of investing is not necessarily for everyone. It's a great trend, but you need to understand the shortfalls as well. And Joe, I think this is an area that, this type of investing has been around for a little while, but it's kind of gaining some steam these days.
Oh, sure, without question. Socially responsible investing has been around for 20, 30 years. But with anything, there's trends, right? And so it's exciting in one degree because it's giving an outlet for other individuals maybe to get excited about investing. But of course, there's going to be downfalls as well to look at, well, what really am I investing in? Am I truly diversified? What are the costs? What is the rate of return, and so on? So we're going to dig into all of this. But before we do that, Al, let's just kind of, what is like ESG? Because I think ESG is getting some steam, but let's kind of just define what the heck we're talking about.
Yeah, I think that's right, Joe, because this has been called a lot of different things. ESG is kind of the term, the initials that have sort of stuck, I guess, if you will. It stands for environment, social, and governance. So why don't we start with environment? These would be companies that are trying to help or reduce the climate change. So these are companies that are all trying to act responsibly.
Your environment looks a lot better than my environment as we speak here.
It's very nice. It's lovely here in Hawaii.
Speaking of social distancing, another part of ESG is social. So this is looking at work environment, employee relations, diversity, things of that nature. And then finally is governance. So when you look at governance, it's, what's going on with the overall executive pay. It's kind of the big Wall Street people, the decisions of the big corporate governance to make sure that it's in line with what your overall values are. So as you can see, with ESG, it gets fairly deep into several different aspects of kind of our social environment. And so some people, when you look at investing in these types of funds, you might really agree with one side, but don't agree with the other. And so this is where we get into some unique fund creation where they're really taking this to a minute level. In L, I think a lot of times people need to be more careful of, all right, hey, I like the concept. I really think that this is important, but you might need to do a little bit more research when it comes to this.
Well, I think that's right, Joe. And so nowadays there's some rating companies that try to numerically put a score, an ESG score on various companies. But the problem with that is the rating companies have different methodologies, so they come out with different numbers. And probably most importantly is what may be important to you may not be important to your neighbor. So in other words, maybe you're really concerned about environment. Someone else is really concerned about women's rights and animal rights and social type issues. What's interesting is looking at which factors are most important to ESG investors, and it's pretty much split across the board. I mean, it starts with rate of return. About 17% of people were saying that's the most important aspect of this. 16% said social impact, then goals of the company, and then just slightly less environmental impact. So it's interesting. It's not like one is sticking out. All three seem to be important to whoever the person is. So as you invest in this sort of thing, it's really important to kind of focus in on the types of companies that support the cause that you're interested in.
Yeah, but I think more importantly, too, if you kind of take a look at the numbers there, I mean, rate of return, what's going on with the overall company? Is it a good company? Are they profitable? You know, what type of industry are they in? And then you look at past performance. So still, the foundation of investing is still there, but then you just put a social impact on it, which could be a really cool thing. So what I want to do is I want to bring Brian Perry in after the break here and break things down, because there is a lot of hype. This is a mega trend. And where you want to make sure that you understand the good, the bad, and the ugly with any type of trend in investing. And he wrote a new book that we're giving away. It's Ignore the Hype. Look at this. We got a full hardcover book from Brian Perry, so you don't want to miss this. We're going to give this away. If you want a copy, we got a couple advanced copies for you if you go to yourmoneyorwealth.com. I don't know how many we have, but go to yourmoneyorwealth.com, click on that special offer. Hopefully you are a lucky winner of this wonderful book. We got to take a break. We'll have Brian Perry when we get back. He's CFA Senior Advisor here, Director of Research, all sorts of stuff. You know who he is. No introduction needed. Show's called Your Money or Wealth. We'll be back in just a second. Hey, welcome back to the show, folks. Show's called Your Money or Wealth. Joe Anderson and Big Al Clopine, who's hanging out in Hawaii this week. Hey, check out Brian Perry's book. It's Beyond the Hype. We got some strategies. It's financial strategies beyond the media mayhem. Go to yourmoneyorwealth.com to get this hardcover, yourmoneyorwealth.com. Speaking of Brian Perry, he's going to join us in just a second. But before we get him on, let's see what Al does with the true-false question.
Since ESG funds often require active management, the fees can be higher for these types of investments. And that is true. And the reason it's true is because the fund managers that put these investments together, there's a lot more research and a lot more that goes into it.
You know, I think with any investments, they're not all created equal. You have actively managed funds, you have passively managed funds, and there's going to be a variety of fees in regards to any fund that you select. So I think, you know, really doing the due diligence with any investment. If it's ESG, if you're buying a large cap growth fund, you want to make sure that you understand what is the mechanics and how it is created. So I agree with you, Al, but not 100%. So just do your due diligence. And speaking of due diligence, let's bring in Brian Perry. He's the Director of Research. He's a chartered financial analyst and the author of this book, Ignore the Hype, Alan. Or Alan, hey.
Brian.
Yeah, Brian, same, right?
Yeah.
We're talking ESG today.
Yeah.
Right? Let's get into the pros, because I think there's a ton of pros, and I'll let you be the bad guy and you can go with the cons.
I appreciate that. Thanks. Yeah.
Right?
Yeah.
So what I find fascinating about this is that it's going to bring a lot more investors, and we've seen this. It's bringing more investors to the forefront because I'm passionate about a certain topic or an issue or whatever the case may be. And so people will invest, and when markets go bad, they're probably not going to sell out. Because if I have an index, the S&P 500, well, I don't really care what the hell is the S&P 500. But if I'm investing in a company that I'm truly passionate about, I'm probably going to stay with it for, you know, good times and bad.
No, I would agree with that, and I think what you just mentioned is probably the biggest benefit, outside of the obvious, right, is that we're financial people, but we still want the world to be a better place, and the idea of marrying investing with some sort of social good probably makes some sense. But the important part, I think, and again, I get to play devil's advocate or the bad guy, but the financial part needs to come before the save the world part if you're going to call it investing.
Well, if you, I think that's another pro, is if you look at investing in general, people will need to invest to get a certain target rate of return. If I keep my money in cash, if I keep my money in bonds, if I keep my money in CDs, or I might get stuck buying a certain product with high fees, with all these bells and whistles that I really don't understand, we'll need to get a certain target rate of return to achieve our financial goals, because a lot of us are not necessarily, ahead of the game in regards to savings. So if we can invest in something that will give us a higher target rate of return than, let's say, cash or CDs, right? It's going to help people get to their financial goals. And the end all is looking at, why are we investing to begin with, right?
Yeah, precisely, right? This is like anything else. The idea is you figure out what you're trying to accomplish. For a lot of people, that's maybe retirement, right? What do you need to save? How do you need to invest? What rate of return? And then it's layering on an additional filter or some sort of additional criteria around causes that people are passionate about. Importantly, though, right, you need to look under the hood, just like with any financial product. I think that's key.
You were our director of research up here at Financial Advisors, managed $2.5 billion and some change. We have, and you're part of the head of the investment committee and everything else, so you're very familiar with how you look at research in regards to funds. What can our viewers learn from your research capabilities if they wanted to get into, let's say, an ESG or socially responsible or impact fund? There's so many different names now. You Google it and you're going to get bombarded with information. And I think even the SEC is like, hey, this is getting out of control because these big Wall Street firms are using this as a ploy to get more investor dollars, but the underlying transparency could be, not so great.
Yeah, and I think that's the first, and that's the point of the book, right, is that there's so much hype out there, you need to whittle it down. And I think beginning with the end in mind is always key, right? So it gets back to some sort of planning to figure out what kind of return people need. And then from there, as an investor, what we would do is we would back into what sort of portfolio mix might let you get there, right? And so again, that comes down to that mix: stocks, bonds, real estate, cash, whatever other asset classes. That doesn't change just because you're taking an ESG bent, right? And then from there, it's deciding, okay, for each of these sectors or for each of these segments, so I want large company US stocks, or I want small company stocks, or I want bonds. What vehicle do I want? And I think that's where the ESG part comes in, is when you get to the security selection, you might exclude, let's say, the S&P 500 and look instead towards ESG or socially responsible type alternatives.
So if I'm constructing the portfolio, it's the first decisions I want to make is, all right, well, how much money I have in stocks versus bonds, right? Because then that will help dictate what target rate of return. And then from there, you slice the pie up even more. Say, here, I want this in large companies, real big companies, here in smaller companies, international emerging markets. And then I create that. And then now it's like, all right, well, if I want to cut the pie even to get a finer cut, if you will, you could say, I just want socially responsible. Then you could pick your funds giving those criteria.
Yeah, but I think that's where the real challenge comes in. Although, to be honest, statistics show that that's the least valuable from an investment perspective part of the process. It's the big picture that contributes the most to return.
The asset allocation is going to drive most of the... So if you're ESG or non-ESG, is it going to have that big of a difference?
It'll have a difference, but what's going to determine whether you get where you want to go is the asset allocation, and frankly, whether or not you're saving enough.
If I am investing totally in socially responsible funds versus none, am I going to achieve a higher rate of return or lower?
If I knew the answer to that, I'd be a rich man. The answer is maybe. I mean, the idea of socially responsible funds is this is not charity, right? Impact investing tilts a little more towards you're trying to do good and returns are a secondary consideration. ESG, you want to make money, and the idea is that you'll get higher returns, and here's why. The idea is that either you're overweighting companies that are contributing to what the future will look like. So call it like wind power or something like that, right? A clean tech, right? Alternatively, you might be trying to avoid landmines. And the best example here is an energy company, right? Like British Petroleum, Deepwater Horizon, spills oil in the Gulf, stock gets cut in half. The idea is with ESG screens, you compare companies to their peers and you reduce your weighting to or eliminate companies that might be more prone to step in it. And thereby you avoid large losses, you get better returns. That's the theory at any rate.
It sounds pretty good.
It sounds really good, right?
But what's the problems? What are you seeing? I mean, you screened a bunch of ESG and socially responsible funds and so on and so forth. I mean, what issues do we have here?
Well, the biggest one, first of all, is that nobody really knows if everything I just said is going to come to fruition, right? It's a relatively new space. So we can say, like, yeah, in concept, it seems like those companies should do better. And over any short period of time, maybe they have. Who knows what the future holds, right? So that's one. But I think the second is that the idea of ESG is that you're layering on your social views to investing. We're all individuals, right? We have an election coming up so we can see what the world looks like and all the differing opinions, right? Everybody doesn't think the same way, so you've got to go find funds that A, share your views, right? That could be tough. But then B is that are good investments, right? And now you're doing screens around what's the cost of it, right? Just like the true-false question, what's the investment approach, who's the manager and stuff like that. And so then that takes some expertise to find the best funds as well as funds that reflect your views.
Yeah, and I think there's now micro funds, right, to certain causes. You can get really granular, and then instead of having, a broad-based portfolio is going to give you 12,000 stocks or 15,000 names, right? So if one company goes under, you're still going to be protected. But if I get really granular and just say, I want this tiny specific area of the market, you could be taking your universe to a very small town, for lack of a better
Analogy, thank
you.
That's why I'm the research guy, right? The words, I looked it up. Right. No, yeah, you're absolutely right. So one of the big benefits of investing is diversification is essentially a free lunch, right? And if you narrow down your window, you might find that you're concentrated in certain sectors, right? So if you're really environmentally conscious, you're probably not going to hold a lot of energy companies, right? What if you're in an environment where those are doing the best? Now, if your personal views are more important than portfolio returns to you, that's not an issue. But if your number one concern is getting good returns, that could come into play. But the other thing is just when you look under the hood, what are the odds that if you build a fund, it's going to hold exactly the vehicles and the views that you have, right?
Almost impossible.
Almost impossible, right? There might be things you love and then something you're passionate about that it doesn't own.
Right. Let's talk about the book.
Yeah.
We got Ignore the Hype, Financial Strategies Beyond the Media-Driven Mayhem.
Yep, beyond the media-driven mayhem.
So I think with any investment, the media drives a lot of people to do different things, right? Talk about it. What's going on? What can people learn when they get the book?
Yeah, well, first of all, I want to acknowledge we're on TV talking about ignoring the media. So ignore most of the media, don't ignore your money or wealth. That's the first thing, right? Sure. But the other part of it is the news gets paid, right? It's the 24-hour news cycle, and it's the idea that there's all these outlets, whether it's on TV or online, that need to attract eyeballs. They throw stuff up at the wall to see what sticks, and you know what? A boring report on the latest economic number doesn't drive eyeballs. It's sensationalist, right? It's ESG, frankly, right? A rapper can sound really exciting. The reality is very different. So the point of the book is, first of all, to make people aware of that and really reinforce how much absurdity there is out there in the media, and that one of the best things they can do is to turn off a lot of it. But then, two, is to convince them that there is a path to success that doesn't involve competing with large institutions. Because I think that we're in a world where institutional investors have a lot of inherent advantages, but so do individuals. And if you can drown out the noise and take an approach that focuses on advantages instead of some of the trying to compete with somebody from Goldman Sachs or some huge hedge fund that has computers and PhDs and resources, that's a loser's game, but there's a winner's game out there and a path to success if people choose to take it.
Absolutely. It's a great book, great read, quick, easy, fun. If you like this kind of stuff, I guess. And if you're watching this, you love this kind of stuff. Get your copy right now. Go to yourmoneyyourwealth.com. Yourmoneyyourwealth.com. I'm not sure how many copies that we have. Hopefully you are a lucky winner, since we are, these are just advanced copies. I think I got the first one. And I'm going to have Brian sign it right after the show. Speaking of that, we got to take a break. We'll see how Big Al's doing in Hawaii. We'll get to the true-false question, ask the experts, all sorts of good stuff. Don't go anywhere, folks. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson and Big Al Clopine. Look at you.
Loving it, Joe. I'm sitting here in Poipu on the island of Kauai.
Yeah, it looks like you're in your kitchen.
Well, I actually am to be more specific, right. I'm right near the kitchen.
You can see the fridge right behind you. Nice little plan. Who staged all that?
Oh, well, that was me trying to come up with a good studio because I didn't have my crew here. I had to do it myself.
Let's go to the true-false question.
ESG is only applicable to certain companies, such as those in energy, manufacturing, and mining industries. Well, that's actually false, because I mean that's part of it, right? That's the environmental part, but there's the social part and the governance part. These really affect all companies, and to some extent, almost all companies have some sort of environmental impact. So no, this is really for virtually all companies, and investors need to be aware of that.
Yeah, I mean, it's a slippery slope too. You know, this is, what do you call it, Al? A hot potato?
I do. I do.
It's a political hot potato.
It is. It's a little tricky right now, Joe, and so because people are very passionate about their causes, and people are passionate about different causes, which makes it hard to get a uniform standard.
Yeah, and that's why this is basically, you know, there's a little bit of shortcomings in regards to this. It's not a one size fits all, is what you would say, Bud?
Correct. Yeah, I mean, I think that's probably one of the most important things, and maybe what you might call a shortcoming, is that you can't just like pick a fund and say, okay, this is the fund, because different funds are going to focus on different things. Different rating agencies have different ways of going about this. So you got to do a little bit more research on what types of funds or stocks that you want to invest in if you're passionate about a certain thing, because with all of these corporate governance, social and environmental, it's like, well, what is important to me? And again, it takes a little bit more research, Joe, than just, you know, typical investing.
Yeah, and anytime you invest, you want to make sure that you do your research so you understand exactly what you're getting into, what the fees that you're charged. You know, and there's no silver bullet, because of if you really enjoy a certain aspect of you know the market, and you really want to narrow your selection, they could be really great companies, but there's no guarantees that those companies are going to continue to perform. So there still needs to be certain metrics to happen for us to achieve a rate of return. So, hey, Al, let's switch gears a little bit. Let's go to Ask the Experts.
To keep my portfolio diversified, what percentage of my portfolio should I allocate to ESG funds? This is from Cynthia in San Marcos. Cynthia, that's a kind of a hard question to answer, because ESG funds are in virtually any type of asset class. So I think it's kind of how much of your portfolio do you want to invest in ESG type funds? Maybe all of it. You know, I don't know. But in terms of keeping yourself in a balanced portfolio for your own goals and needs, you can do that with ESG funds. You can do that with non-ESG funds, or you can do it with a mixture.
Yeah, I don't know. I think, Al, too, with our experience, is that if you're going to go ESG, you got to go all the way. It's like it'd be weird. It's not an asset class to say, hey, I want to be socially responsible in one area but not in the other. I guess that doesn't necessarily make a lot of sense to me. Again, there's pros and cons of doing this, so it's not, hey, let's put 10% in ESG, or unless you say, hey, I want 10% in a particular area of of the marketplace. So it's a slippery slope. It gets a little bit tricky there, depending on, truly what are you trying to do with your investments.
Yeah, and Joe, I think partly I was thinking that maybe you want to have some emerging markets, and maybe the emerging market companies don't have reporting on ESG type issues, and so you really don't know. So you may have to mix and match a little bit, but I agree. For those that are conscious of this sort of thing, usually they want to be in as much as they possibly can.
Yeah, like with our portfolios, if someone wants a socially responsible portfolio, the whole portfolio is constructed around that, which is really because someone has beliefs in others and not. So that's why we're trying to tread lightly here. Let's go to the next question.
I want to invest in environmentally friendly stocks and funds rather than social issues. Can I find funds that just focus on being green? This is from Clyde in Elfin Forest. And Clyde, you can. It's like a lot of this is somewhat of a new thing with the ESG. So it just takes a little bit more research to figure out not only which funds are more focused on environment than other issues, but which funds maybe, or which companies may focus on the environmental issues that you're most passionate about.
So what did we learn today, folks? we're talking about portfolios with a purpose. I think all portfolios have a certain purpose to get us to our specific financial goals. But some of us want to get a little bit more granular in the overall investments. Is it right for you? It could be, could not be. You'll be missing out on certain sectors of the overall market. You might lose a little bit of diversification. You got to educate yourself to make sure that you are absolutely sure of what you're investing in, of course, and then, hopefully they will get you to your financial goals. That's it for us. Hopefully you enjoyed the show, folks. ESG. Something new, something different. We're just trying to throw some stuff out there, keep you educated, to get you more in line. Avoid the hype. A lot of hype, a lot of information out there, a lot of marketing ploys. If you want to get educated on the best investment strategies out there, get Brian Perry's book, Ignore the Hype. Go to yourmoneyyourwealth.com. We got a few copies. Get them while they're hot. For Big Al Clopine in Hawaii, I'm a little lost without you, bud. Not gonna lie.
Well, I'm having a good time, so you're just gonna have to grin and bear it best you can.
All right, we'll be back again next week. I think Big Al's still gonna be in Hawaii. I don't know if he's ever gonna come back, so we'll probably find another co-host to keep us afloat. So go to yourmoneyyourwealth.com, get on that special offer while they're hot. We'll see you again next week. Show's called Your Money, Your Wealth.